Advanced Principles Podcast, or APP, was created to be an outlet for like-minded individuals to share in the broader conversations on leadership, retail market updates, and incredible personal success stories. On APP, you will hear a collection of stories from the titans of the retail industry, as well as thought and practice leaders covering the spectrum of the economy. Please click the subscribe button and look for the newest episodes to be released.
To demonstrate what kind of bonds we're buying, what kind of stocks we're buying.
So I think it really speaks volumes to the business that you've created.
Dealers asked us, look, can you guys manage onshore reinsurance trust account?
The U.S. automotive, retail, reinsurance participation space. On this episode of APP, we speak with Chris Dalziel from London & Capital, a private wealth management firm based in London, England. Chris is an executive director within the institutional division at London & Capital and joined the firm in 2012 with a regulatory background. Chris acts as a relationship manager for existing institutional clients and is responsible for the development of London & Capital's reinsurance trust business in the U.S. Chris also works with insurance clients in Bermuda and beyond. He regularly travels across North America, meeting with clients and working with insurers to build, develop, and execute bespoke investment strategies. Chris is a graduate from the University of York and holds degrees in economics and law. He also holds the Chartered Insurance Institute's DIP C2 designation and has passed level 1 of the CFA program. Please join me in welcoming Chris Dalziel. So Chris, that's a fantastic introduction, great bio, and we're really excited to have you on APP today. So everyone, please welcome me and join Chris Dalziel from London & Capital to the podcast today. Welcome, Chris.
Great, thank you. Yeah, I'm really pleased to be here, and obviously feeling very privileged to appear within the first 5 episodes as well. So looking forward to it.
Good. Well, we're very excited. So we'll dive in. I'm sure that there's a lot of information that we want to cover, a lot that our listeners will have a lot of interest in, and certainly some things that I'm looking forward to learning about you and the business model as well. So as we just kind of unpack, give us a little bit of background on yourself, let people know who you are, where you came from, your background, and how you got into the role that you're currently in.
Yeah, okay, great. Absolutely. Thanks, Ryan. You could probably guess that from my accent that I'm not from Arkansas, but I'm not sure my professional journey is the most riveting, but I'll give it a shot anyway. So you could probably tell I grew up in the UK, born and bred here over in England. When I was 14, actually, we had the opportunity as a family to move to the US. So I actually spent my formative years, I guess, in Miami, in Florida. That was really where my love of America was really incorporated. So, it's an experience that has actually, I think, looking back, influenced my career so far. I guess when I was 18, I took the tough decision to leave the US and head back to the UK for college. And it was a blow that was probably softened by the fact that my parents remained in Miami for another 4 years. So between school breaks and things like that, I was still able to come back and enjoy the fantastic weather. And I wasn't completely surrounded by the grey clouds of England. But yeah, university in the UK, I studied economics up in the north of England, in one of our sort of most ancient cities, I guess, York. And in the UK, colleges are only 3-year courses, but I specialised. So you specialise from day one. And I specialized in economics. So I was thrown into the deep end a little bit, but at the end of the 3 years, I had a really great time, and I had a degree in economics. Wasn't sure what they wanted to do with it. That was the only problem. At the time, I was pretty happy, pretty content to remain as a student. So I decided to spend another couple of years doing a postgrad sort of degree in law. Although saying that, I quickly realized that I didn't want to spend the rest of my life as an attorney. So I thought about how else I could put that education to good use, and ended up working for one of the financial regulators here in the UK, which seemed like a pretty decent fit given my background. After a few years there, I really wanted to understand how the other half lived and worked. And so went across to the private sector. Ryan, you'll know this story well, but at the time, William, who's my father and the founding partner of the institutional team at London Capital, was looking for someone to come in and help him work with his team, which there was 3 of them at the time, on a compliance project. So I stuck my hand up, and 10 years on, I stuck around until they gave me a proper job. So like I said, I've been here for 10 years. William stepped down as partner in 2017. But I think many of your listeners will probably, appreciate and understand that working directly with my dad over sort of the first 5 years that I was at London Capital was a fantastic experience, something that I didn't necessarily expect to happen, but something that's really shaped my views on how we put clients first and the importance of building long-term relationships and all of that kind of stuff. But that's how I ended up at London Capital. That's how I ended up sort of looking after our book, I guess, of reinsurance business in particular. So that's kind of a bit of a whistle-stop tour, I guess, on how I've gotten here so far.
Yeah, fantastic. Some bounces across the Atlantic a couple times, and a good journey through education, and then working with your father, that had to be an exceptional treat. So very cool that you guys were able to do that together and enjoy that part of your journey as you go.
Yeah, absolutely. And I think that's something that obviously you see replicated, especially in the auto dealer space, where there are a lot of, family companies. And I think it's fantastic to see that legacy sort of properly passed down and looked after sort of through the generations is really something that I personally find really interesting to see.
Yeah. Generational success. It is very common within the dealer space. And certainly my son now works for our agency, so we're excited about that. And a true gift. There's no question about that. So how did London Capital find their way into the U.S. automotive, retail, reinsurance participation space?
Yeah, it's we often get asked, how the hell do you guys from London get over here? Why are you managing my money? Why are you interested in this dealer space? And to be honest, it's been a bit of a journey for us as a firm, and certainly us as a team. As a firm, we were set up almost 35 years ago now. We were set up in the mid 1980s here in London as an independent wealth management firm. And from day one, I guess our investment philosophy is really focused on capital preservation and liquidity, which is, the quite traditional focuses in the wealth management space, especially here in the UK. But our client base as a firm became international very quickly. And so we've specifically always had US individuals as clients, be them US individuals who are living in the UK or Europe, who have a lot of expat needs. They have dual tax reporting and lots of complexities around planning and things like that. And to that point, we've been a SEC regulated, registered investment advisor for a long time. In the early 2000s, we had, as a firm, we had an office in Miami supporting our private client business, specifically in the US. But while we were out there, I guess we realized that there was an opportunity to work with captive insurers, especially captives who are domiciled offshore in places like Cayman Islands, Bermuda, Barbados, and also further afield in the Caribbean, like Turks and Caicos, a domicile that I'm sure most dealers listening would recognize as one of the premier domiciles for reinsurers in general. Those small captives, those small insurers, those small reinsurers weren't being particularly well serviced at the time by local investment managers, and many were allocated to expensive investment funds that weren't particularly suited for insurers. Our investment philosophy, our investment approach of investing in individual stocks and bonds really resonated, and the rest is history. I guess we've now built up a team of insurance specialists that have been servicing our insurance clients for 15 years. And that really adds to our differentiation today. But in terms of how we got specifically into the dealer participation space, I guess we were introduced to it from a captive client. So around 2006, we started managing assets for a group captive owned by dealers. So they were doing F&I products. They were also doing reinsurance for a number of sort of business related risks. But after 4 or 5 years of sort of working with them consistently, delivering our promises, etc., dealers asked us, look, can you guys manage onshore reinsurance trust accounts? And that was the first time we'd come across those kind of F&I businesses. I guess the reason why they asked is because at the time, again, the investment options, the returns weren't particularly compelling. And so there was an opportunity to sort of develop something from scratch that had been sort of specifically designed, I guess, for reinsurance companies. So it took us a few years to flesh out what the strategy might look like, the best bank to partner with, best reporting platform to partner with, etc. But it wasn't until 2013 that we were finally able to sort of offer a properly integrated and joined up solution for trust accounts. So that's how we got introduced to the space. Today, we're managing around 400 reinsurance trust accounts across a number of different insurance providers and things like that. So we've seen a lot of growth over the last sort of 8 years. But yeah, that was kind of the journey into it. And I guess it's, classic wealth management in the sense of it's word of mouth, right? So that's really how we got into it. And we saw there was a genuine need there for us to solve.
Yeah. So from 2013 to now, 400 individual reinsurance captives or companies that are held, and all by word of mouth. Certainly, you're not in the trade publications. You're not a retail institution here in the U.S. that dealers would be aware of, or certainly broadly aware of. So I think your reputation precedes you in all of those referrals, which is how I got introduced to you, and our dealers are starting to get introduced to you. So I think it really speaks volumes to the business that you've created. So since 2013, how have you seen that landscape shift? Certainly, I started becoming familiar with reinsurance and captives and asset management back in 2006. And from 2006, it certainly took a leap. But I think the leap from 2013 to now has even been bigger, where dealers are starting to be exposed to the idea of, not just taking what's offered to them off the shelf, whether it's a single line trustee and asset manager in a very retail kind of drive up ATM type philosophy, where we're going a little bit more customized, a little bit more bespoke, as you would say, and those results are garnering. So what are some of the biggest changes that you've seen since you've entered into the space in 2013?
Yeah, I think that's a really astute observation. I think that's definitely aligned to what we've seen as well. I think from a structuring perspective, I think if we rewind the clock to 2006, there were a lot more group captives, right? There were a lot more dealers sort of banding together. There was probably a lot fewer dealers participating in reinsurance programs. So you ended up with these bigger dealers who were banding together, and that made a lot of sense for them. They've obviously become a lot less common, largely due to a lot of the US tax changes that came in around sort of 2017, 2018 with the definition of essentially passive foreign corporations changing and making it less tax efficient. Those offshore captives now need to have a lot more scale. You also need to make sure that the bigger dealers aren't sort of dominating the premiums and the asset base and things like that. So arguably what we've seen is this sort of wave, I guess, of individual dealers and dealer groups taking a lot more control over their reinsurance programs. I think you could probably argue that was a trend that was sort of already coming, but probably accelerated by some of these tax changes. Mm-hmm. And I think you've also seen a lot more agents becoming a lot more astute to the options available, right? So I think there was certainly this sort of dynamic of, okay, well, this is the menu, this is what you can choose. Mm-hmm. And I think dealers are now pushing back and saying, hang on a minute, I want to choose something else. My agent uses this guy. I want, whatever it might be. And I think in response, we are seeing definitely those insurance providers sort of changing their models a little bit and sort of becoming a little more flexible. And quite right too. I mean, I think there's no reason why they shouldn't encourage more flexibility. That seems like something that we should be able to accommodate given all the tech changes that have also happened. And I think, to the broader point, if we think about casting our minds back to 2006, when, the top 6 of the top 10 biggest companies by market cap were, oil companies and banks and things like that. Today, it's all technology, right? 8 out of 10 of those are technology. And this, we've already gone through, 3 major crises in that time. The world has changed. We've got a lot more scope to be customizable. I mean, in 2006, the closest thing we had to an iPhone was an iPod. I mean, that's just unbelievable, isn't it? Yep. The fact that society as a whole, we've had this huge exposure to the internet, and which is basically universally available now. And I think most dealers recognize that you should be able to sort of plug in what they really want into their own reinsurance arrangements.
Yeah, it really has become a more globalized world. And certainly you're in one of the most global cities in the world, being in London, and certainly is one of the most international cities that I could imagine. And I do think that the globalization and kind of opening up the blinders for a lot of different dealers looking beyond, I think is good. And certainly, I think if we go back pre 2010, certainly even pre 2016, 17, when you were, like you said, just giving the dealer a menu and saying, here's your sign up fees, here's who's going to be the trustee, here's who's going to be the asset manager. Most of those that are being presented to dealers have a business model where dealership participation or reinsurance or asset management of those funds is a rounding error on their balance sheet. So how much attention do they really get? I think one thing that I've
Yeah.
really come to appreciate with London and Capital, and certainly I know our dealers appreciate, is that it's a big chunk of the business and it's not a rounding area, and it does take a personal approach, versus some of these other major multi-billion dollar commercial banks that just do it as an aside. So talk a little bit about, the importance of dealer reinsurance in London and Capital's overall business structure and philosophy.
Yeah, good question. So yeah, I mean, for us as a firm, we're a specialized firm, right? So we manage around $5 billion of assets, and about 2/3 of that is for traditional private client wealth management business. So outside of what we're doing for institutions and insurers. So within our team, we manage around $1.4 billion, and about 400 to 500 million of that is for dealers, for dealer-owned reinsurance structures. And so it's a really critical part of our business. Mm-hmm. It accounts for a lot. We invest a lot of money into it, invest a lot of time and energy into making sure that what we're offering is still what dealers need. And I think from our perspective, we appreciate that dealers have a lot of choices when it comes to choosing asset managers, and I think that's right, and that's to be encouraged. And we just talked about actually the fact that dealers do have a lot more choice now, and that's quite right, because I'm a firm believer that actually a healthy competitive environment is the best way to ensure the best outcomes for users, consumers, clients, whatever term we want to use. So I think, the way we look at it is it's a core part of our business. We have built a team here in London that are specialists in this area, be it in insurance, captives, reinsurance. We talk about insurance all the time, every day to our clients. And so this isn't just a pool of money to us. We understand that this is here to support a business, and that's the underwriting business. While the investment piece is an important part of that, as you quite rightly said, fundamentally, you don't want to blow anything up, and you want to make sure that money is there for claims and all the kind of the good underwriting activity that needs to happen in order to generate the bulk of the return. So, I think our business it takes a unique approach in a couple of ways. So from an investment perspective, we invest very transparently. So we don't invest in funds or mutual funds or ETFs where we can avoid it. We invest in individual stocks and individual bonds. That means that we can sort of tweak the risk. We can make sure that we are taking the most amount of risk that we can in accordance with the trust rules, but yet we're not also sort of tripping over that line. It also allows our dealers to actually understand what we're invested in, which fundamentally sounds simple, but without looking underneath the line of the ETFs and the funds that a lot of our competitors use, you'd have no idea. And certainly in trust accounts where fixed income is the biggest part of the allocation, investing in the biggest ETF funds just gives you the largest slice to the most indebted companies in the world, which doesn't make sense for equities, where you've got, I've got a slice of the biggest company in the world, but do you really want a slice of the most indebted companies in the world? You have to be a bit more selective and think through that nature. So, buying individual fixed income does allow us that flexibility. We're committed to transparency anyway. So part of that is creating an all-in fee for clients that they really understand it. And I think to your point about service, that's absolutely critical for us. And to that point, we've invested a lot in finding the right reporting partner for us, where the clients are able to see their entire portfolios online, practically in real terms, and download statements that sort of work for them, and create that sort of ease of administration that otherwise are lacking, perhaps when banks send you a PDF statement and you have to pull off all the numbers yourself and all that kind of stuff, right? It's kind of make it as easy for people as possible, right?
That's and dealers don't want to sort through all of that and go through and try to figure out where their performance is. And it's a difficult number to pin down anyway, but it's made more difficult by the lack of transparency a lot of these retail institutions would provide to the dealers or the overall client. And one way that I've coined it up to several of our dealers who I know we've made the transition to you is active asset management versus passive asset management. And like you said, I think a lot of the historical firms have just loaded them up on ETFs or high expense mutual funds tied to an index or whatever it is, and then just let it ride. And whatever it is, and they're not making any trades, they're not monitoring the funds because it's just, a rounding error, like I said, on their balance sheet. I think your firm takes a very active approach in the asset management. And I think you guys have done an extraordinary job. And I want you to spend just a couple minutes on it, on those initial consultative calls versus just putting a piece of paper in front of a dealer and say option, A, B, or C, which is much like a target retirement fund here in the US with a 401k or something like that. Yeah. Whereas you actually have a conversation, have dialogue with the dealer, understand what they're looking to get out of these funds. Talk us a little bit about that and then how that active asset management drives those overall results.
Yeah, great. So, in terms of the active versus passive, I'll come to that in a second. But I think you're right. It all starts with the initial conversation, right? Make sure that clients really understand what we're delivering and that clients understand what their own objectives are for these funds. Part of that is probably trying to succinctly explain what the applicable trust rules, right? Because I think there is a temptation for dealers to be like, hey, why I've only got 20% allocation to equities? I want to be high. There are a lot of rules that need to be adhered to when it comes to managing trust accounts in particular. So, talking dealers through what practical restrictions there are upfront is a lot easier than disappointing them in 6 months or a year's time when they're wondering why they haven't got the exposure that they envisaged. So I think setting that standard initially is absolutely a good starting point. The other thing we like to do is find out more about their business. So look at their recent session statements, understand how much cash flow is coming into the reinsurance trust account, understand what level of maturity that reinsurance trust account is. Is it in runoff? Is it adding? Is it growing? Et cetera, et cetera. The cash flow piece is really critical when you've got ins and outs happening on a monthly basis, and making sure that, again, to your point, actively managing that, not just buying assets and holding it and liquidating it willy-nilly when funds come in, but just trying to actively plan for that. And then I think, in terms of actually executing it, talking to the client, showing them what a portfolio looks like, demonstrating the reporting system, and using a real portfolio to our investment philosophy is. Because I think when it comes to active versus passive, I think one of the things that is easy to understand about passive is, I'm just buying the S&P 500, and I know how that works because I understand stocks and I don't need to think too much about it. But what we're trying to do as an active manager is obviously outperform both, whether it's more returns or less risk. We're trying to get a better result for the client than they would have otherwise gotten from buying a passive strategy. So we have, a couple of equity strategies that we implement for clients, talking them through that, what our rationale is, getting our head of equity on the call to explain that if necessary. And it's the same for fixed income, right? We have a distinct approach to that. We like corporate bonds. We like financial bonds. We're not huge fans of government debt. We're not huge fans of long dated bonds, all these kind of things. Trying to explain our rationale, trying to get the client to buy into that, trying to explain as well what the likely outcomes are. So here's what a good performance might look like. During these kind of market conditions, we might have a bit of a rocky period, whatever it might be, but it's managing those expectations is absolutely key to it, but also explaining how we are active as we go through it. Explaining that stuff again, like I said, initially up front, often is a big time saver, and also sets the expectations properly. Because I mean, the other point to make, I guess, is that some clients don't want active management, and that's absolutely fine. I mean, we're not trying to be all things to all men. We're just trying to do what we believe we can do very well in a quite a focused manner.
Yep. So over the last year and a half, and really, I would say the last probably 4 years, especially in the U.S. market, there's been so much volatility, so many ups, so many downs, so many crazy swings, high and low. How have you been able to manage over the overall expectations and results with the dealer clientele? In case if somebody turns on CNBC one morning and they see that the Dow is incredibly down or incredibly up, they think that their portfolio is going to perform exactly the same. And we all know that that's not always the case and very rarely is. So how do you manage those overall expectations when dealers are hearing record high, record high, record high, and it's still a trust managed account that has to be within regulatory compliance and everything else? So how have you been able to manage that and respond to the inquiries?
To your point, we've got to be crystal clear about how the investment guidelines operate. So what is allowable, what isn't allowable, what parts of the markets will generate the bulk of the return for the trust portfolio, what part of the markets are interesting but ultimately inconsequential, and making sure that actually at the beginning we explain that, and that dealers then aren't surprised when, like you said, the S&P's at record highs and their account is kind of ticking along nicely, but it's not lighting the world on fire. I think applying those two specifics to those 2 points to the investment environment that we find ourselves in today, I think we need to make sure that dealers understand that fixed income performance is actually the biggest driver of returns, and unfortunately, fixed income doesn't get a look in on CNBC. I mean, the scale of the fixed income market is vastly outweighs the scale of the equity market, but it's a lot less exciting. It's very boring, right? So, making sure that clients appreciate that actually in the grand scale of things, the fixed income environment, the amount of yield that you can expect is unfortunately at historic lows, and that's because it's very much tied in with interest rate and inflation expectations, which again are sort of rock bottom really, and that won't be surprising news to anyone. But I think there is also an opportunity to zoom out as well. So when you're speaking to the dealer, which is when you're looking at the whole reinsurance arrangement, dealers are going to be making a lot of their money from underwriting. That's the performance of course of the F&I products that they're selling. So the investment returns, they're important. They are, they can really meaningfully contribute to especially covering the costs of the reinsurance structure on an annual basis. But fundamentally, if we're blowing it up, or the money's not there to pay claims, or the money's even worse, not there to pay dividends, then we're going to get into hot water, right? And so making sure that we're being a good, sensible steward for the money while staying within those those regulatory trust guidelines is critically important. I think for us, when we speak to dealers, I think it's really about taking a step back, trying to understand what their business objective here. It's not your 401k, right? So I mean, it's a different risk profile. It needs to be treated differently, and certainly the amount of exposure that you can get to risk assets is much diminished, and so there needs to be that kind of that context. But as you know, Ryan, there are other ways around it, right? So we can talk about B accounts, we can talk about there are ways to build that exposure, but it's about working up to those conversations as the reinsurance arrangement matures and as those opportunities come up as well.
Yeah, and I think that it brings up a great point. And certainly over the last several years, the buzz has been, dealers having access to their trust accounts day one, with different DOWC structures, dealer obligor structures, all of that. And dealers have this fascination of wanting to hold the reserves from day one and invest it how they see fit, whether it's in cryptocurrency or Coinbase or whatever else it might be. And the long and the short of it is you said, it's capital preservation, because the funds have to be there to pay claims. So there is a built-in necessity to be conservative in the investment nature until it becomes surplus and can be moved to a B account and so forth.
Hey everybody, this is Michael from ADS. Myself and the entire team would like to thank you again for listening this week, and to Chris for sharing his story about how he got into the industry and speaking about some of the different options available to dealers. Next week, we will discuss his insights on the current market, how the U.S. consumer will be shifting, and his love for America. App is available through Amazon Music, Apple Podcasts, Google Podcasts, iHeartRadio, YouTube, and our website. Don't forget to hit the subscribe button to be notified of the latest episodes.